You're listening to the Non-Del Influencers Podcast, brought to you by FirstFunding. Join host Matt Coles as he delivers powerful conversations to help non-delegated lenders succeed and scale in today's market.
All right, everyone. Thanks for joining us on the latest episode of Non-Del Influencers Podcast. I am joined today by the great Tom Davis of Deephaven. Tom, Chief Sales Officer, is that right?
Yeah. Chief Sales Officer, I do it all. Whatever it takes to win and drive production. You know how that goes.
Tom, how long you been over at Deephaven now?
3 years. So,
okay.
3 years at Deephaven. Decided to join them. They were early pioneer in the space going back to 2012. And one of the first to kind of get out there and securitize, help bring liquidity to the market, bring some products into the market, and being in business to business and correspondent sales and wholesale sales throughout my career, I got to see these guys early on at shows, driving awareness of this market when it wasn't sexy and no one really wanted no one knew what it was, right? So they had a great brand and a great parent and a lot of all the components needed to be successful in the non-QM space. So I joined about 3 years ago, and
nice.
It's been exciting, and I've been in non-agency pretty much even pre-financial crisis all day kind of world, and I love selling the service and expertise versus price, and non-QM allows you to do that.
Yeah, so I got to ask you. So I see you on the road a lot. You are what I would call a road warrior.
Yeah.
Take me through what your process looks like as you're going on the road. I mean, you're always, how do you maintain the balance between what needs to be done in the office versus what you're doing on the road? I mean, I envy it with you. I've told you that before.
Yeah.
I get bogged down if I'm out of the office on the road for 3 or 4 days. How do you balance all that?
Yeah. Just not just travel and just conference, you got to have the right people, right leaders under you, and right team. And when it comes to just my overall workload, not just the conference and which conferences to attend, I try to focus on the needle movers, what's going to move the needle. There's always projects that are going on and things that you could do, but I try to stay focused on what's going to drive the needle. And so, like, from a conference standpoint, I think this year we might have like 60 to 70 on the books.
Wow.
We go to wholesale conferences, we go to banker conferences, we go to private lender events, for the RTL, fix and flip and bridge, and hard money. So we're all over the space, driving awareness around non-QM and our product offering, trying to drive production. And I just have to pick which ones, where I think I can make the biggest impact, maybe where I'm going to get more exposure for our organization and our sales team, when it comes to like being on panels and driving awareness, and then, where's the biggest opportunities with the client base. So those are the ones I try to focus on. I see you add a lot of those as well, right? So you got that pitch down, as well.
I think the road has probably added about 20 pounds to my waistline since I've been on the road quite a bit. But I'll figure it out how to balance all that. One of the things I wanted to ask you, which was, so if you go back 3, 4, 5 years ago, pretty much every conference that we were attending together was, hey, let's talk about non-QM. Hey, LOs or originators, are you guys doing any non-QM? And for so long, it was like, let's just get them to try out one loan. Right? Now, when you go to these conferences, pretty much everyone knows what non-QM is.
They're non-QM conferences now.
Yeah. So what are you trying to, like, how did the conversation evolve from where we were 3, 4, 5 years ago to what you're talking about today? Is it trying to get them to dive deeper into segments of it? Give me a little bit of an idea what you guys are talking about.
Those are great questions. Like, yeah, definitely, the product has evolved over the last, let's call it, since the evolution, because early on it was more of about a credit event. The product was there to solve, help people that were in a foreclosure or bankruptcy, since right out of the financial crisis. And, today, when it comes to credit events, non-QM is only like 2 to 3% overall production, where before majority. And so now, it's 50% bank statement, 40% DSCR, and then, all the other features and, fall into, or the extra 10 to 15%, right? So, it's interesting because non-QM has grown 3x over the last, let's call it, 3 years in production. Went from 30, let's call it billion. This year, we're going to expect to hit about 100 billion. That's just non-QM. That doesn't include, all non-agency, which this year is expected to hit 200 billion. But there's still major opportunity for LOs to adopt these products. And what I've seen and what we spend a lot of time doing with our clients is trying to understand their needs, what their strategy is, what markets are they trying to penetrate. For example, 1 out of every 4 purchase transactions last year was a investor transaction. Right. So if you're an originator today, on your website or on your business card or whatever, right, you should say that you specialize in investor transactions. And if a quarter of your business is not investor transactions, you need to know why, because that's a quarter of the market, right? That's been a change. You've seen the SCR loans kind of, be a higher share. What's interesting is, there's 19 million that account homes in the United States or properties that account for 49.5 million investment properties out there. There's close to 20 million in self-employed people that account for over 30 million businesses. So higher self-employment rates in the United States. Close to 50 million people are part of the gig economy. They have multiple jobs. So that's really taken off. So you've seen bank statements and alternative ways to qualify for income. Another thing, look, 1 out of every 3 transactions, this is a pretty interesting stat. 1 out of every 3 transactions last year was a new construction transaction. 1 out of every 3. So we have a supply demand imbalance of about 5 million homes in the United States.
Yeah.
So if you want to be a part of the solution and help, bring new inventory to the market, right, then there's products out there. And I know mortgage bankers, a lot of them can't bank this product, but there's products out there that'll allow you to finance the builder and have that builder bring the inventory to the market, right? Because now you're financing the builder to build a property or project with $20 million. Now you give them the financing, but then you can say, all right, builder, since I helped you get this financing, I'd like to be the takeout for all the consumers that are going to be buying your units. So now you're going further upstream and attacking those builders, and then you could be the takeout for the consumers and be their preferred lender, right? Or preferred originator. And that, once again, that's a third of the market, and 5 million undersupply of housing over the next 10 years. We need to build homes or renovate existing homes that are uninhabitable, bring them back into the market. Like the guys that are doing fix and flip, real estate investors, they renovate those properties. When they bring them back into the market, guess what? They need a solution to rent it out, right? And that's a DSCR loan. So
your sales team at Deephaven has to be really great at solution providers. And let me just hit on this, right? Because, if you're an account executive out there and you're getting inbound phone calls, I would imagine what the Deephaven account executive is like taking the inbound call, but saying, hey, by the way, based upon your profile, I see that you're only doing 5% of non-owner occupied properties. Did you realize it was 25%? Or did you realize that 1/3 of the homes were new builds? Or however, all these stats that you just gave, I would imagine that your sales team is completely just giving solutions to originators on a regular basis, right?
Yeah, absolutely. I mean, look, we have all-time high equity at 35 trillion, 1.6 in equity, home equity. We have 1.6 trillion in credit card debts, 1.1 trillion in auto loan debt, right? People need to tap into their equity to consolidate their debt and improve the cash flows. People need their equity to renovate their homes. The average age of a home in the United States is 40 to 50 years, and everyone is in, like 80% of people are in a rate lower than 6%, like 75% are lower than 5%. So all these people are not going to move out because they're stuck in these lower rates, and they can't, they can't trade up to a 7% rate, and the taxes and the insurance. So there's all these surveys that show people are going to stay home. So they need to renovate their home. Actually, more than 50% of second lien originations in the United States are actually home renovation. And think about all the investment properties in the United States. I just told you there's 19 million, and 1 out of every 4 is an investment property. Think about all those investment transactions or investors out there that have bought these properties that are stuck in lower note rates. They're not going to cash out because it's going to worsen their cash flow. They're going to take a second lien to go buy more investment properties. So second liens is another solution. So what we do at Deephaven, we take a strategic approach. We do like 80 to 100 webinars a month for our clients around our products, how to source these products, the different features within the products. We do a lot of white label presentation for our partners, for their realtor partners, and present of our customers' behalf to never know it's Deephaven. So what I would recommend for everyone that's listening to this, Matt, this is the best idea that I could give everyone that's listening today. And I preach this at all the events that I go to. The top 5% of realtors in the United States or realtor teams control 90% of the listings. The bottom 95% of realtors only have 10% of the listings. So all the loan officers out there, and you look at originators in the marketplace, it's the 80-20 rule, right? The top 20 are doing all the production because guess what? They're calling the 5% of realtors, and they have relationships with 5% of realtors who have 90% of the listings, and those guys are moving the weight in real estate.
Right.
Guys that don't have deals today, more than likely, they're calling on the bottom 95% of realtors, only have 10% of the listings, and they're wasting their time.
Yeah.
So what we're saying is leverage these products, leverage non-QM bank statement, DSCR, asset utilization, non-warrantable condo, foreign national, I-10. You leverage all that stuff, right? Ground up construction, fix and flip bridge, second liens, leverage that stuff and target the top 5% of realtors and say, hey, I know you probably worked with these 2 LOs over the last 10 years of your career, but I specialize in these alternative product solutions. And, some of them you can broker, but I could bank a lot of these. I'm the lender on a lot of these products, and I have expertise. And just like if you're an attorney and a lawyer or a financial advisor, if you're really good at these alternative products in your market and you adapt them and you embrace them and you become the expert in your market, those realtors and all the other referral sources outside of their realtor, there's probably 50 other referral sources, will come to you because of the expertise. And so you leverage the products, differentiate yourself from the rest of the competition, and go to those top 5% of realtors who have the listings. And that's how you're going to drive production in a challenging market. So we're teaching our counterparties and our partners to leverage products and tap into the guys that are moving weight in the real estate game.
Tom, you're speaking my language here. You're speaking my love language more than my wife sometimes. But when we talk non-delegated, you and I have had a lot of conversations about this. Non-delegated, I stress the importance of leveraging the non-QM product space. Selfish plug, FirstFunding does support non-QM on the warehouse facility, and we do it very well. The idea of branding it and bringing it out to the marketplace as your product, XYZ lender. You are the lender of that facility, and you are the lender of that loan. And so what you're saying is brand yourself as the lender and the expert in any one of the segments. You know what? I think sometimes, Tom, maybe people go out with too big of a fishing net and they try to catch everything in the sea, right?
Right.
But if you go out and say, you know what, I'm going to focus in on first-time landlord DSCR buyers, right? That could be a segment that you could go out and market yourself as the expert and as the lender. And guess what? You break down that wall of like, well, are you really making the decisions? The common consumer is not going to absolutely know what's going on there in the non-delegated space. So I'm sure you're seeing that quite a bit on your side.
Yeah, look, you're speaking my language. I'm an avid fisherman, and my lines are always tight.
Yeah.
And when I go fish, or you could go fish for different types of fish, right? Whether it's pelagic, in the middle of the ocean, the migratory fish, bottom fishing on the reef, or 1,000 feet deep, sword fishing. There's all different types of fish you can fish for, right? But you need different tackle, different approach, different baits, different weights, different kind of reels, and the different lines, etc. Right? Each species is a little bit different. So that's how, like, non-QM, I treat non-QM, right?
Oh,
Or
good.
like a doctor, if you have a patient, each patient is different. So
Right.
like, you're 100% right. So like, if I'm an originator and I want to focus on self-employed people, you know what yesterday was? It's painful yesterday, right? It's tax season. You had to pay. Everyone had to pay taxes, right? And give money to the IRS. Or self-employed people, guess what? They are experts around minimizing or optimizing their tax strategy. You know how they do that? They go talk to CPAs. So if I'm an originator, I would go talk to every CPA and accountant in my backyard, and I say, hey, I specialize in self-employed people to help them optimize their tax strategy, and I can help them buy homes. We look at their bank statements, and by the way, not only am I an originator that focuses here, and I specialize and work with a lot of CPAs and accountants, but I'm actually a lender, and I use my funds to fund these deals, right? So now you're going to the CPA. I can guarantee you, all the lenders and originators in their backyard are not calling every CPA or bringing flyers to the CPAs saying, and by the way, we have flyers that we could white label that, with your NMLS and your logo. Just like we go to conferences, Matt, I would go to CPA conferences or accounting conferences.
I'm gonna trademark this idea, but I'm gonna open it up to everybody. If April 15th is known as tax day, I don't know why every originator isn't visiting their local tax people in their local market on April 16th and saying,
correct,
congratulations, you did a phenomenal job of minimizing the income for the borrower. Let me help them qualify for a new home purchase or
refinance
or whatever they need, right?
Yeah. I don't need to look at their income on their tax returns. I know you're an expert at what you do. Look, the CPA might say, hey, you are right. I am an expert. I've had that problem with my tax returns. Can I use this product for myself? You might be able to help the CPA. And look, those CPAs, it's like a cult. It's like the non-QM cult. They all know each other. So what I would do is I go to the next CPA conference and I put up a booth in the back, and there might be 500 CPAs. And I'm the only guy there saying, hey, I specialize, and I'm a lender that specializes in self-employed people, helping them purchase and refinance and take cash out of their property to use to fund their businesses.
Right.
So that's one way.
Yeah. April 15th is tax day. April 16th is loan originator non-QM specialist day.
Correct. And then the list goes on and on. Like we could spend 3 hours. Like we have mountains of webinars that we gather all this intel and best practices. And if someone says, hey, you know what, Tom, Matt, you were saying to me, Tom, we did a conference for a big lender, 500 originators. And they're like, yeah, we don't really see that many investor transactions. I'm like, well, how much do you see? You're like, well, what's the percentage of your investor transactions last year? They're like, I don't know. I'm like, okay, can you pull the data while we're on this? I'd like to know.
Yeah.
They said it was 9%. I go, on a national average, and you're a national lender, you're doing loans all over the United States, it was 25%.
Yeah, so you're not attracting a buyer.
I'm like, so you're under-indexing the market. That means that your competitors are picking up your market share because you're not competitive here and you're not offering DSCR. Let me tell you what your LO should do. Your LO should call every loan they've ever done for an investor in the last 10 years at your company and say, I offer DSCR, I have cash out, I have fix and flip bridge, I have construction, and start there, right?
Yeah.
Guys, they're already investors. If they're not, they should then potentially look at joining a real estate investor club. You have one in your town. I have like 6 in South Florida.
Yeah.
So join a real estate investor club, market your product, and go to all the investors, the developers, the fix and flip guys, and say, hey, I have DSCR up to 9 units. I have, I could do seasoning less than 6 months on the appraised value. I could do loan amounts, and then that's where all the investors. I'm fishing in a spot where it's like heavy investors. There's a school of them. Like we're talking fishing now, right? There's a school. They're all bunched up. Let me go to where I know where I put my bait, I'm going to catch more fish, right? That's how you catch the investor.
There's a Facebook group for people who only do gig jobs, right? The gig economy, what we talked about. There's a Facebook group that just says, hey, I picked up this little gig. I picked up this little gig. As a loan originator, why wouldn't you be inside there And again, you got to balance the idea of you don't want to sell, but when you see opportunity, you want to advise.
Yeah. And one other nugget for the group out here that's listening is what I would recommend. Every deal that you've done in the last 15 years of a purchase, they all have equity.
Right.
Pick up the phone and say, hey, how are you? I'm looking at, the analysis when you bought your house, like your equity is, this is a market analysis of what the value is. It's pretty simple. You could get that on Zillow, a couple others, places. And you can say, hey, by the way, I don't know, like if you know this, but you have a ton of equity. Just wanted to check in. How are things financial? Are you looking to buy or rent? Are you looking to invest in investment properties? Do you have any outstanding debt, whether it's credit card, auto loans? Have you thought about consolidating? Have you thought about staying in your home? How long, right? By the way, you could tap that equity to do renovation, to do consolidation, to buy an investment property. And you're just calling the touch base with them. And if you don't make that phone call, there's guys that are making those phone calls, and they're going to take your client.
So you segue into a perfect opportunity I want to talk about, which I know Deephaven is doing really well on the second lien position. And I'm always the advice that you just gave is fantastic, because I'm always surprised by the originators that aren't going back to their borrower base and asking that. Because I know in my mailbox I get 2 or 3 credit union flyers about second liens and HELOCs and all this stuff on a regular basis. My bank statements typically have some type of insert on it.
Yeah.
I'm getting bombarded with this information. And if you could just touch on the evolution of what you're seeing in the second lien space, probably quite honestly over the last 2 years, and how much it's exploded, about what the marketplace might be for that opportunity.
Yeah, I mean, securitizations and just originations, you're going to see like a 2 to 3x this year over last year, and last year was a big year because originations are like 1.8 trillion to 2 trillion this year. Last year they were 1.8, and the market was at 4 trillion, and 3 years ago, right? So originations are down. So loan officers, they have to adopt all these products that we talked about, including second liens. But second liens, the reason it's really big is because the majority of these people that everyone has done loans for, they're in these lower note rates, and they're stuck. It makes no financial sense or economic sense for someone to do a refinance cash out. And we have a calculator on our site, deephavenmortgage.com, where you can actually run this scenario, and you can show the borrower, hey, I know you're thinking about a cash out, but it doesn't make sense. You should probably do a second lien, right? The blended rate's going to be X. And then they can consolidate their debt. They can renovate their homes. And look, I mean, this is public data. You can see Rocket is one of the largest second lien originators in the United States, right? And guess who they just bought, or they're buying? Mr. Cooper, right?
Yeah.
And they're going to be owning $2 trillion in servicing. Guess what Rocket's going to probably do? They're going to probably tap into that 2 trillion of equity and continue to call on those guys for second liens, because refi cash outs don't work anymore right now in this environment.
Yeah, and what we run into, Tom, on our side is, well, I'm just a non-DAO, and I'm like, well, FirstFunding allows second lien on your warehouse. I don't know why you're not going out and originating it or talking about it. And I see so many opportunities, and I just feel like it's kind of an overlooked opportunity for a lot of our lenders in that space.
Yeah.
And I love what you're saying.
Yeah, look,
I'm never moving out of my wife would kill me. I'm never moving out of this house because I got a low rate in the mid-2s on my house. Like I'm never giving up this interest rate.
No, you know what you're going to be forced to do? If you're going to move, you're going to be forced to be an investor. You're keeping your house, and you're going to go buy another house. Because I'm in the same boat right now. I'm in the low 2s. I have a low balance. Not like it's low, right?
Yeah.
And so I'm thinking to myself, my kids they're in college. My son's in college. They're going to need a place. I'm going to have to help them because the affordability is through the roof. The average age of a first-time home buyer is 38 years old in the United States. So I have to help my kids with housing. It's no longer thinking about college. It's thinking about housing for your kids. So I'm like, okay, if I move, I have to keep this house. I can't get rid of the mortgage.
Yeah.
So the kids will have to move into my house and they'll pay me rent, and I'll keep this with low interest rate mortgage. And that's a lot of people are going to be forced to be investors. So anyways, yeah, that's why you're going to see a lot more people tapping into equity.
Do you have, without mentioning names, do you have someone in mind that successfully shifted from like, hey, I'm a company that does first liens to now they're like, hey, I'm going to do second liens. That's what my focus on. Can you take me through how they went about that change, what market opportunities they're taking advantage of, and how are they leveraging the Deephaven products?
Yeah, I mean, you're not just going to lift and shift your entire model, right? Some guys have. There's a couple guys, I know a guy on the West Coast and on the East Coast, a couple guys, they took an interesting approach because they went and started buying leads that were like really cheap, like leads that no one wants. So they're buying leads that are for like $25,000 to $50,000 HELOC leads, right? Mm-hmm. And and then they're calling them and saying, hey, by the way, we know you're interested in a second lien closed end or HELOC, and it's a potentially 20,000 to 50. Do you know that you qualify up to 100 to 200,000? And let's talk your financials, like your scenario. So they bought cheap leads that no one wanted, and now they're leveraging that and going after higher loan balances instead of paying up for the $150,000 to $200,000 leads. But by the way, the average ALB for my second lien today is like slightly less than $250,000. So these are real deals for closed end.
So your average loan amount is a little bit less than 250.
That's right. Less than 240, like 240,000 today.
Wow, that just shows you how much equity there is in the marketplace.
Yeah, there's a lot of guys out there. We could go up to 750,000 in California or across the United States for a closed end. But there's guys that have all the major servicers, like the servicer that I'm with, in my insert, I get the what is it called, the opportunity for the second lien, right? So now if you're a banker and you sell your servicing, right, then you can't say, hey, I'm your servicer, but you could pick up the phone or send them an email and say, hey, we did your loan 3 years ago. That's an easy phone call. How you doing, Matt? Hope all is well. How are the kids? Just checking in. Are the kids out of college? How's the house? Are you looking to do any renovations? By the way, I got a sweet deal for you, for that product. That's a second lien, right? So now you're staying engaged with them as like a financial advisor. It gives you an extra phone call. All those people you've ever done a loan, that's an extra phone call, right? I would work with.
It's not one phone call though, Tom. That's what we always preach over here. It's consistently following up, right?
Yeah.
It's at least every, I would hope every 6 months, but more frequently probably every 90 days.
Yeah, there's a saying I always use. I've heard it before too, but the fortune's in the follow up, right?
Yeah, absolutely.
Go ahead. Another thing I would say is, look, work with like contractors, renovation folks, plumbers, builders, roofers, all these guys. If a roofer needs it, let's say a roof costs $40,000, $50,000, in my neighborhood, right? Well, like if you give your card to all the roofers and say, hey, I could give you really attractive financing for your buyer, for the guys that need roofs, give me a call. We could use our equity and we could get them closed in 10 days or less.
Yeah.
Right. So, so there's all these opportunities. I know, people even go to Home Depot and Lowe's and work with the contractor area where people do buy all their materials. They're like, hey, if you know of anybody doing any major projects to their home, here's my business card. I could help them tap into their equity so they could finance these projects. So there's so much that there's opportunities everywhere in the market. Either you get it or someone takes it from you, but you got to be proactive and you got to be relentless, in driving your production.
Yeah, and I think that the non-del lender has a leg up with the ability to brand.
Absolutely.
The ability to brand, the ability to follow up, the ability to work with a good investor like yourself. and put those on your warehouse facility. Reach out to your warehouse facility to see what their parameters are. I can certainly share what ours are over here. But what I'm hearing, Tom, from you say is that we've moved beyond 3 to 4 years ago, defining again and again and again to an originator what non-QM is. Now we're starting to evolve into, okay, how are you segmenting out your business to go attack this?
Yep.
I love your fishing analogy. It actually hit hit home for me. So I really do appreciate that.
Yeah.
At the end of the day, what's next on the non-QM horizon? What are you seeing as the biggest thing? I know there's a couple products that I'm not so familiar with that you guys are selling over there as well.
Yeah. I would say from a product standpoint, so we're aligned. Our sister company is Anchor Home Loans, so we have access to ground up, fix and flip, and construction. So I could do up to $20 million projects for construction for a 1 to 9 unit. And on fix and flip, I could do up to 10 million, and then bridge. And then we also have a home builder finance division that you can work with home builders to provide financing up to 200 million in financing for folks that are building, for builders, the experienced builders that are building like whole communities. But those aren't products that people are going to be banking. Those are going to be brokered.
Yeah.
So we're always looking to develop products and continue to expand there. But going back to your other question, I think originators, why they should feel comfortable working with Deephaven. We offer full line of business. We can do wholesale, non-delegated, and full delegated, so multi-channel delivery. And if you're doing non-delegated with us, we've been doing delegated and non-delegated since inception. And I would say about a third of our business is non-delegated today. Wow. We have a strong, very, very strong presence there. And our underwriters are stateside, very seasoned. So when you get an underwriting decision from us, we stick behind that, and you should feel very comfortable funding it and putting on your line at FirstFunding.
Yeah. All right. Well, Tom, awesome conversation, man. I really do appreciate your time, and I'm sure we will see each other on the road here very soon. Thanks again, and thank you everyone for joining the Non-Del Influencer podcast.
I appreciate it. Thanks, Matt.
Thanks, guys.
Thanks for tuning into the Non-Del Influencers podcast, powered by FirstFunding. For more resources and episodes, visit nondelinfluencers.com.